You're listening to OPIS Talks, where you'll be in on conversations with insiders in the energy, chemicals, and environmental commodities markets. Guests share insights into the latest trends and innovations, industry challenges, and much more. Let's dive into the conversations that explore where the energy economy is headed, right here on OPIS Talks.
Hello and welcome to another edition of OPIS Talks. I'm Humberto Rocha and I'll be your host today. One of the most important topics this year in Europe, and arguably for anyone engaging with the European market, is a revision of the European Union emissions trading system, also known as the EU ETS. The EU ETS is the world's oldest cap-and-trade system. This is a system that puts a cap on emissions and incentivizes companies to decarbonize or risk having to purchase carbon allowances that are gradually lower and lower in supply. For example, if you're able to decarbonize, you don't have to buy as many carbon allowances and you can sell them on the secondary market. For players who can't decarbonize as easily or have more troubles doing so, they risk having to buy more of these European carbon allowances to fulfill their obligations. This market has been online since 2005, and as we enter the market's third decade, we see a number of changes being proposed by the European Commission. In mid-July, the European Commission unveiled its long-awaited proposal for changes to the EU ETS. And today, I'd like to welcome our carbon reporter Nia Simeonova to walk us through the latest. So, the European Commission unveiled its revision proposal for the EU ETS in mid-July. Nia, could you tell us a bit about the work that you do, and also as we look at this review, what does the EU ETS do, and why is the European Commission proposing these changes now?
Hi, Humberto. Thanks for having me. It's good to be here. So, as you already explained, the EU emissions trading system, or EU ETS, puts a price on the carbon emissions of European plants, large industrial plants, also power sector, and domestic flights. And every large industrial and utility operators are legally obligated to surrender 1 EUA, European carbon allowance, for every metric ton of CO2 or CO2 equivalent they emit each year. So this is the EU's landmark climate policy. It's probably good to give some context into prices. Historically, prices were very low in the beginning. So from an average of, I think 2013 was less than €5 per metric ton, to then in 2020, the average was around €25 per metric ton. OPIS assessed a record high in February 23 of more than €100 per metric ton. That was during the European energy crisis after Russia invaded Ukraine the previous year. As we can all see, the price is going up. And so this policy is gaining more and more visibility. So to your second question, why this is happening right now, there are 3 things to note here. So firstly, that's just the design of the system. Every 5 years, the EU opens this directive and negotiates and changes it in a way that keeps it relevant and keeps it able to address challenges that might arise in the future and also recent challenges from the past. So the last major review was the Fit for 55 package. That was back in 2021 when I dare say the geopolitical landscape was very different from now. The second thing to note is that there has been a profound shift in Europe's emissions pattern. So in the first 20 years, the power sector was doing most of the heavy lifting when it comes to emissions reductions. We saw coal to gas switching, a rapid rollout of renewables, and that was highly responsible to the carbon price signal. But today, it's time for the heavier industry to decarbonize. And that is a very different, so I'm talking about sectors like steel, chemicals, cement, paper. That is a very different situation because decarbonization in industrial scale requires massive investments in technologies, in clean technologies that have not reached maturity yet. So they're not commercially mature. I want to also mention there is this debate of how effective has the EU ETS been for reducing industrial emissions And there was a study by the LSE's Grantham Research Institute that went out the day before the proposal. And it showed that, according to the study, industrial emissions fell by 41% on average in the period 2021 to 2023. There's a lot to debate there. And then the third thing to note is what I already hinted, is that the review and the proposal is very dependent on what the geopolitical landscape is. So we've lived through the European energy crisis following the war in Ukraine. At the same time, European industries are facing very tough global competition right now. So in essence, this proposal now, according to analysts, represents a sort of shift from cap and trade to cap and invest. And industries are saying that we might end up deindustrializing Europe rather than decarbonizing it. So that's the opposite side, the industry side. And they're saying that the stick of a high carbon price is not enough if there isn't the carrot of investment support, which is an important part of that proposal, I guess, that we're going to talk more about. And just lastly, I want to add that the entire trajectory of the carbon market needs to be in line with the EU's new and legally binding climate target for 2040, which is a net 90% reduction in emissions compared to 1990 levels.
Thank you, Nia, for setting up that context, the evolution of the EU ETS, the pricing, especially. That's something that we specialize here at OPIS, but it's really interesting when you lay it out to see the evolution of the EU ETS and where we currently are. Obviously, very different from the geopolitical background we were even 3, 4, 5 years ago. Nia, as you've had a chance to look at the European Commission's proposal, what are some of the more outstanding proposals that you've seen from the European Commission?
Well, the first one, the most significant one, is the linear reduction factor. So that is the linear reduction factor, or LRF, determines the rate at which the annual carbon cap shrinks. So the shock factor on the day, on July 17th, was that the Commission actually proposed a two-phase trajectory post-2030. They proposed that from 2031 to 2035, the linear reduction factor is slowed down to 3.7% from the 4.4% we are currently on track to hit in 2028. No major surprise there. Analysts and just the market was already counting in a linear reduction factor of 3.4%. So actually that's a little bit less of a reduction. What was actually the most surprising is the LRF post 2035. It's set to slow down to 1.7%. And that leading carbon analyst Mark Lewis reminded me that that is the same LRF as before the Fit for 55 package of 2021. So until now, we were supposed to reach zero by 2039. But with the slowed down LRF to 1.7, that means that there will be carbon allowances issued well into the 40s. And the LRF is supposed to reach, according to current OPIS calculations, is supposed to reach zero by 2048. So that is 9 more years. So that is one of the major, most notable changes that people reacted on the day. And the second major proposal, apart from the introduction of international credits, which we can talk a bit more about in this conversation, but that was the establishment of an industrial decarbonization bank. So that is a 100 billion euro funding vehicle to support industrial decarbonization. And the first step in that tool will be the investment booster, which I think the Commission announced it way back in April. So the investment booster includes 400 million allowances, or roughly 30 billion euros. So the Commission was using a price of 75 euros per metric ton there. That was supposed to enter the market between 2028 and 2030. Now, that was a big fear, that market participants feared that all of these allowances, 400 million, will be injected in the market all at once. That is not the case. Instead, the Commission has attached some very strict conditionality rules to these funds. The 400 million allowances will not be auctioned, but instead they'll be allocated to companies for free. But that will happen only after a qualifying project has taken a final investment decision, completed construction, begun operating, and officially proven its emissions reductions. So because of all those steps, market analysts are expecting that a very, very small amount of those 400 million allowances will reach the market before 2030. And another part of the proposal, which is somewhat overlooked, was the conditionality that now is going to apply on traditional free allocation. Traditionally, free allocation involves giving free allowances to big industrial plants from sectors that are strategically important. The idea there is to keep them competitive compared to their global counterparts that are not really paying such a high domestic carbon price. But now, what the Commission wants to introduce, starting in 2031, is an 80-20 rule. Industrial installations will only receive 80% of their free allowances annually upon submitting an approved decarbonization plan. The rest, the remaining 20% or 1/5, will be held back by the regulator and only granted at the end of the 5-year period. And that's from the original document by the Commission. It will be only granted at the end of the 5-year period if the company can officially verify that it implemented decarbonization investments corresponding to 100% of the economic value of its free allocation, and that those investments actually led to verified emissions reductions. This could mean, according to Mark Lewis, that a massive chunk of free supply will be delayed between 2031 and 2035, tightening the physical market significantly.
Very, very interesting. Yeah, thank you for walking us through. There's a lot of proposals, but these three have been really interesting, especially when you mentioned the steepened drop-off in the linear reduction factor, how free allowances will now be based on conditionality. That's something that I think has been quite substantial in terms of a change. So thank you for walking us through what this could mean for the market, but also how it's been received. Something else we've seen in recent headlines and that we've also written about is the discussion regarding the potential inclusion of international carbon credits into the EU ETS. I believe in the first phases of the EU ETS, there was actually certain carbon credits were included in the carbon market. This is not to confuse carbon credits with carbon allowances. We must remember that carbon allowances are the allowances that are part of the compliance market. Carbon credits are the credits that come from voluntary carbon credit projects. So these are very different things, but we've seen discussion around a certain percentage of carbon credits becoming or being part of the EU's climate policies. Could you tell us a bit about what this actually looks like and what questions this has brought up?
This is very interesting because if the international credits end up entering the EU ETS, this will represent a U-turn in European carbon policy because international credits were already part of the EU ETS, but then because of quality concerns, they were banned. But what the Commission is proposing right now is quite unique, actually, and it's a different way of doing it. First of all, individual installations will not be allowed to buy international credits and use them for compliance. Instead, the Commission will set up a centralized purchasing mechanism to procure a total of 260 million high integrity, quotation marks here, international credits over the 2036 to 2040 period. And I put high integrity in quotation marks because that's one big part of the debate. What is the definition of high integrity? Because the international credit market is definitely not, is highly immature. And so the definition is quite contested. Because they're proposing this for the second half of the decade, I think by 2033, they're going to assess if there are sufficient high quality credits, if they are available. If they're not available, then the LRF will automatically tighten from 1.7 to 2.7 for the post-2036 period. Another thing worth mentioning is that there has been quite a big pushback from environmental NGOs. Groups like Carbon Market Watch have come out against the proposal, calling it a severe weakening of the ETS, They argue that allowing 260 million international offsets on top of the 250 million tons of carbon removals that are also included in the proposal is simply a way of delaying the hard work of domestic industrial decarbonization, shifting the burden to future decades or non-ETS sectors. And I just wanted to also mention a few points that are also included in the proposal separately from the international credits. The full phase-in of the carbon border adjustment mechanism will be delayed until 2038 rather than 2034. The Commission also envisions including municipal waste incineration under the EU ETS, so the scope of the ETS is being expanded, also including all departing flights from the EU up to a range of 5,000 kilometers, including private jets. According to Mark Lewis, that is a very smart, politically calculated decision because that includes high traffic flights to the Middle East, but excludes flights to the US and China, which could trigger international conflict or trade conflicts.
Very interesting, to see all these different proposals, but also defining what these international carbon credits are. I want to remind our audience that the CBAM is the Carbon Border Adjustment Mechanism. That's essentially a EU policy that would require anyone, or it will require importers in the EU to pay the carbon emissions of the embedded goods they're bringing in for a number of different sectors, from steel, iron, cement. And this is something that will likely grow. But thank you, Nia, for telling us a bit more about what this actually looks like, but what proposals have been floated as well. So now we're nearing almost a month since this proposal was brought up by the European Commission. And I wanted to ask Nia, how have European Union carbon allowance prices reacted to the Commission's proposals, and where are they currently trading as of the week of the 5th of August?
The initial reaction to the reform proposal was highly volatile, but ultimately flat. The benchmark December 2026 EUA contract traded within a wide range of €4 on the day, but OPIS assessed the benchmark just 31 cents below the previous session. The initial media and analyst commentary focused heavily on the bearish headlines, namely the slower LRF and the 400 million new free allowances. Once the market participants and traders, analysts had some time over the weekend, probably, and into the following Monday to digest the proposal and read the fine print, they realized that there was no risk of a sudden supply dump of the 400 million allowances. So once the market realized that, and once they reviewed the proposal, they found that it was in line with market expectations. So just the fact that it was in line with market expectations actually pushed prices up. And we saw a surge breaking out of the established 72 to 80 euro range that had dominated the market since April. There was a high point on Wednesday, July 22nd, when OPIS assessed the benchmark at 85 euros 20, which was the highest point since January. But then the surge was driven by supportive elements of the reform proposal, but also rising energy prices at that time, because there was some renewed tension in the Middle East at that time. Now, when we approached the end of July, the trading activity tradition, as it happens usually, thinned out. There was some profit taking after that high on July 22nd, and now we're in the classic European summer period when a lot of EU institutions are closed for, at least the European Parliament is closed for August, and a lot of policymakers and carbon traders are actually on holiday. So prices are trading in a narrow technical consolidation range, trading tightly around the 81 euro mark, and there is little conviction in either direction. But that being said, the near-term power market fundamentals remain highly constructive and are providing a solid floor for carbon allowances because Europe is experiencing intense summer heat waves and a lack of rainfall.
Gotcha. And yes, talk about a lack of rainfall. We've seen that England is currently going through a drought. We've seen wildfires in Spain, France, I believe Greece as well. As you well said, Nia, a lot of traders will be on break for the month of August. So I wanted to ask, what does this review process look like? And how long do you think it'll take for these proposals to be cemented, changed? I believe there will be discussion between the bodies at the European Union level. But yeah, what does the review process look like and how long will it take?
The process could take anywhere from 12 to 18 months. And the proposal, as I said, is just the first step. The European Parliament and the Council of the EU, which represents the 27 member state governments, and more specifically the environment ministers of each government, must each draft their own official position, amend the text, and then negotiate a final compromise in what we called a trilogue negotiation between the European Parliament, the Council of the EU, and the European Commission. So we could see the proposal looking very different from what the Commission just proposed, because that's it's a lengthy process. The Council of the EU already met in Ireland before, that was still at the end of July, and some quite deep divisions were already present, according to media reports. Right now, there are two major blocks from the member states. So on one side, you have the 10 countries calling themselves pragmatists, mostly Eastern European states, led by Poland, but also including Czechia, Slovakia, Bulgaria, and Hungary. They hold a blocking minority, and they all want to significantly loosen the rules, delay the upcoming ETS 2 for buildings and transport, and also soften the burden for industry. On the other side, you have more progressive countries like Sweden, Finland, and Spain who want to keep the ETS as it is and change it as little as possible to keep the climate ambitions high. So it will be very important to watch what France and Germany, which camp they join, because given their big populations, their decisions have a big weight. In terms of the timeline, what that looks like, the Commission has got quite ambitious plans to finish that in Q1 of 2027, which a lot of analysts agree that that's highly improbable because this is a very complex process, also very significant for all parties involved. It's not likely for that to happen as quickly, but also it's important to note that there is a massive political incentive of getting that done as quickly as possible, because 2027 is a big year for European elections, with major national elections in France and Italy, and there is some political risk arising from that. And just a couple more points in the negotiations will be important to watch. There has already been some backlash from energy-intensive industries regarding the 80-20 free allocation rule. Heavyweight industrial lobby groups, such as the one for steel, for chemicals, and Business Europe, have already voiced their concerns. They're arguing that forcing companies to tie 20% of their free allowances to massive decarbonization, when the basic enabling infrastructure, such as cheap green electricity and hydrogen pipelines, do not exist in their regions, is unfair. And the second thing is the ETS auction revenues. So last year alone, the ETS made 43 billion euros. Right now, member states are required to spend 100% of this on climate goals. But the Commission is now proposing that member states must spend at least 50% of their national revenues specifically on decarbonizing ETS sectors. And some national ministries might have an objection there. So this is the broad landscape ahead of the negotiations. As I said, all of this will become clear in September.
And so it sounds like we're in this for a while. The Q1 target definitely seems ambitious, but thank you for outlining what the blocks are looking like, what we can expect from this very lengthy negotiation process, and who to watch out for as we see the moves that are being made. Thank you so much for that, Nia. And as we head into our last question, I just wanted to ask, what are some of the long-term implications that you're currently seeing as part of this EU ETS revision?
As we've already said, the European Commission is trying to tread very carefully on a very delicate line between industry and climate goals. And there has been some agreement that it's quite evenly split right now, but maybe it's giving a bit more to the climate goals, wanting to retain the proposal is a bit more green versus growth. This doesn't solve the problem of first movers. And what I mean with this, what Mark Lewis called a moral hazard, is for years the European Commission has been sending a clear message: invest in decarbonization now. The cap is shrinking fast. We were all expecting three-figure prices this year. And many front-runner companies listened. They took on massive debt, and they made expensive low-carbon investment based on the strict rules. Now, by proposing to drastically ease the cap post 2030 and even more drastically 2035, a lot of people see that as effectively penalizing those early movers. And as we have seen, when the Commission is ready to listen to industrial concerns, when carbon prices coincide with quite a tough international geopolitical situation, the Commission is ready to listen to industry. And a few months ago, I interviewed one of the EU ETS architects, Jos Delbeke, and he said that a price of 75 euros per metric ton, which was the price the EUAs were trading at that time, was a fair price. So we're also seeing a more price-controlled mechanism than it used to be. So that is one big shift. And lastly, I want to also point to the complexity that is now introduced with this proposal, with the 80-20 rule, for example, with including international credits, with a different LRF for the second part of the decade. All of this brings another layer of complexity, and we will have to see if the Commission is able to deal with that complexity, explain it, and with tools like the Investment Booster and the broader Industrial Decarbonization Bank to also try to address the issue of the first movers versus the industrial plants that have not decarbonized, that have not invested in decarbonization. But as I said, and the businesses have just emphasized the need for clear price signals, and they want to avoid any one-off interventions in the future. So that's what businesses are quite afraid of. As I said, we will see after September, this could change a lot. This will also depend on the geopolitical situation, and we'll be watching closely.
Exciting to see the layout of what will be a new function for the EU ETS, especially as we look at the goals for 2040, what the European Commission is thinking, what member states are doing, what industry is lobbying for. So it'll be very, very interesting to see these developments in real time. And again, as you well said, this is going to be a months-long process. So we have yet a lot to digest. And while we might be writing headlines every day, we want to see what the long-term effects of these proposals are and ultimately what they shape out to be. Nia, I really want to thank you for being on the podcast with us. This has been a very enlightening chat. And for our audience, I hope this has been of use as we look into the European Commission's proposals and how this will affect European industry, the European energy space, and more as we look forward to 2027 and beyond. Nia, thank you so much for joining.
Thanks for having me.
We hope you've enjoyed today's insider conversation on Opus Talks. Join us next time for a deep dive into another industry insider's world. You can find more Opus Talks episodes at opusnet.com/podcasts or wherever you listen to your favorite podcasts.